Question 1. Institution XYZ uses a historical VaR model based on 5 years of daily returns. During a recent crisis, losses exceeded the 99% VaR estimate. What is a conceptual reason for this breach, and how should risk managers address it? A. Historical VaR overestimates tail risk. No action needed. B. Model fails to include extreme events outside observation window. Managers should supplement with stress testing or Monte Carlo VaR. C. Using 5 years dilutes actual market volatility. D. Crisis VaR breaches are acceptable if annual backtests pass. Correct answer. B. Model fails to include extreme events outside observation window. Managers should supplement with stress testing or Monte Carlo VaR. Explanation. Historical VaR ignores unprecedented tail events. Supplementing with scenario analysis or Monte Carlo ensures coverage of extreme outcomes. Question 2. In calculating parametric VaR, the bank assumes portfolio returns are normally distributed. What weakness arises from this assumption when markets exhibit fat tails, and how can it be mitigated? A. Normality inflates VaR. Reduce confidence level. B. Normality underestimates large losses. Mitigate via T-distribution or EVT. C. Normality assumption is irrelevant. D. Analytical VaR handles fat tails automatically. Correct answer. B. Normality underestimates large losses. Mitigate via T-distribution or EVT. Explanation. Students' T or extreme value theory better capture fat tails, improving tail risk estimation. Question 3. Mr. Alvarez runs a commodity desk with forwards and options on crude oil. A sudden geopolitical event doubles implied volatility and skews risk profiles. What immediate steps should he take to manage risk? A. Ignore volatility. Delta hedge suffices. B. Recompute Greeks. Hedge Vega Gamma using options, run stress tests, escalate to risk committee. C. Close all positions irrespective of cost. D. Defer risk adjustments until month-end review. Correct answer. B. Recompute Greeks. Hedge Vega Gamma using options, run stress tests, escalate to risk committee. Explanation. In volatile regimes, rebalancing Greeks and running stress tests ensures portfolio resilience and oversight escalation. Question 4. A bank using an internal ratings-based IRB model sees its estimated LGD diverge significantly from downturn conditions. How should the bank adjust its approach? A. Avoid provisioning, ignore downturn. B. Use downturn LGD estimates. Adjust with stress multipliers or floors. C. Use historical average, no change. D. Apply instantaneous cure rates. Correct answer. B. Use downturn LGD estimates. Adjust with stress multipliers or floors. Explanation. Regulators require LGD reflect stressed conditions under IRB. Downturn-adjusted LGD avoids underprovisioning. Question 5. Consider a portfolio with low PD loans but high concentration in a single sector. How does concentration risk affect expected credit loss and capital allocation? A. Diversification irrelevant. Only average loss matters. B. Concentration increases portfolio risk. Requires higher economic capital via stress scenarios. C. PD automatically covers concentration. D. Sector concentration only affects operational risk. Correct answer. B. Concentration increases portfolio risk, requires higher economic capital via stress scenarios. Explanation. Sectoral exposure generates idiosyncratic risk, raising potential loss beyond PD times LGD, requiring risk-adjusted capital buffers. Question 6. Ms. Patel oversees credit risk for corporate lending. A major client sees its PD jump fivefold after negative earnings. What should she do next? A. Ignore, loan is performing. B. Update PD, rebalance portfolio, review covenants, run stress sensitivity, report to CRO. C. Immediately call loan default. D. Only inform loan officer, not CRO. Correct answer. B. Update PD, rebalance portfolio, review covenants, run stress sensitivity, report to CRO. Explanation. Event-driven PD increases require governance action, revaluation, covenant review, possible covenant breach, and escalation. Question 7. A trader builds an ML credit scoring model but never documents feature selection or validation steps. What are the model risk governance failures, and how should this be corrected? A. Documentation optional if model performs. B. Lack of audit trail, transparency, validation. Fix by documenting data, features, backtest thresholds. C. Only documentation of predictions needed. D. No issue if business likes it. Correct answer. B. Lack of audit trail, transparency, validation. Fix by documenting data, features, backtest thresholds. Explanation. Regulators, SR 11.7, TRIM, require full documentation and validation to mitigate model risk and ensure reproducibility. Question 8. What is the primary benefit of backtesting a VAR model, and what threshold indicates the model needs review? A. Measures overvaluation, red flag if any exception. B. Validates confidence estimates. 4 exceptions in 250 days indicates recalibration needed. C. Only tests data quality. D. Measures volatility accuracy. Correct answer. B. Validates confidence estimates. 4 exceptions in 250 days indicates recalibration needed. Explanation. Backtesting checks that realized losses align with statistical confidence. Basel tolerates up to 4 breaches, more triggers recalibration or model overhaul. Question 9. Dr. Nguyen leads a team developing a stress testing model for IRRBB. Her initial scenarios miss non-parallel curve shocks. What should she do before the next run? A. Only test parallel moves. B. Add curve twist components. Validate with historical data and peer benchmarks. Document updates. C. Reduce model complexity. D. Skip new scenarios due to time. Correct answer. B. Add curve twist components. Validate with historical data and peer benchmarks. Document updates. Explanation. IRRBB requires sensitivity to non-parallel shifts. Good model governance involves iterative updates and validation against actual market behavior. Question 10. A financial institution uses delta normal VaR, but fails to account for options in the portfolio. Which risk is being misrepresented and how? A. Delta neutral portfolios capture total risk adequately. B. Gamma and vega risk are omitted. VaR underestimates risk in nonlinear instruments. C. VaR always includes options by default. D. Only duration risk is missed in this case. Correct answer. B. Gamma and vega risk are omitted. VaR underestimates risk in nonlinear instruments. Explanation. Delta normal VaR only captures first-order risk. Options involve curvature, gamma, and volatility sensitivity, vega, which must be captured separately or via full revaluation methods. Question 11. An FX trading desk hedges currency exposure daily, but faces large intraday swings. What risk metric and control could better address this? A. Sharpe ratio. B. Intraday VaR with real-time thresholds and hard limits. C. Weekly average VaR. D. Rolling beta exposure. Correct answer. B. Intraday VaR with real-time thresholds and hard limits. Explanation. Traditional daily VaR fails to capture short-term volatility. Intraday VaR and real-time monitoring help manage risks in highly volatile markets. Question 12. Mr. Oak manages a sovereign bond portfolio with exposure to curve steepening. A central bank unexpectedly flattens the curve. What risk metric failed, and what should be done? A. Standard duration measures failed. Switch to key rate duration. Conduct scenario testing. Escalate impact. B. Convexity failed. Ignore and rebalance. C. Spread duration failed. Stop using VaR. D. Delta failed. Reprice immediately. Correct answer. A. Standard duration measures failed. Switch to key rate duration. Conduct scenario testing. Escalate impact. Explanation. Parallel duration masks non-parallel curve shifts. Key rate duration isolates yield curve segment impacts and should be integrated with scenario-based stress testing. Question 13. What role does exposure at default (EAD) play in expected credit loss, and how can banks estimate it under stress? A. EAD is irrelevant in ECL. B. EAD models should incorporate credit conversion factors and exposure usage under macroeconomic stress. C. Use a fixed percentage of line utilization. D. Apply average utilization to all clients. Correct answer. B. EAD models should incorporate credit conversion factors and exposure usage under macroeconomic stress. Explanation. EAD reflects expected exposure at default and is a critical driver in ECL under IFRS 9 and CECL. It should include forward-looking conversion factors and stress assumptions. Question 14. A loan with a low PD but high LGD due to unsecured status has what type of risk? A. Concentration risk. B. Severity risk, which affects expected and unexpected losses. C. Funding liquidity risk. D. Wrong-way risk. Correct answer. B. Severity risk, which affects expected and unexpected losses. Explanation. High LGD increases expected and unexpected loss. Even low PD loans with high LGD contribute to economic capital under stress scenarios. Question 15. Ms. Jimenez is head of retail credit modeling. She notices that default patterns have shifted post-COVID and current models underpredict delinquencies. What governance steps should she take? A. Wait until regulatory deadline. B. Conduct model recalibration, document shifts, revalidate with updated macroeconomic drivers, and escalate to the Model Risk Committee. C. Ignore it's temporary. D. Reduce model usage. Correct answer. B. Conduct model recalibration, document shifts, revalidate with updated macroeconomic drivers, and escalate to the Model Risk Committee. Explanation. Model governance frameworks, e.g., SR 11.7, require recalibration in response to changing dynamics. Proper documentation and escalation are essential. Question 16. Why is backtesting important in model risk management? A. To check data entry. B. To validate predictive performance, identify drift, and support recalibration decisions. C. Only useful during stress testing. D. It replaces scenario testing. Correct answer. B. To validate predictive performance, identify drift, and support recalibration decisions. Explanation. Backtesting compares predicted outcomes with actuals, helping detect model underperformance, ensuring robustness, and justifying redeployment or retirement. Question 17. How does correlation affect model risk in stress scenarios? A. Correlations are always constant. B. Correlation breakdown during stress increases tail risk and undermines diversification. C. Higher correlation reduces model complexity. D. Correlation never affects capital. Correct answer. B. Correlation breakdown during stress increases tail risk and undermines diversification. Explanation. Under stress, assets once considered uncorrelated may co-move, collapsing diversification benefits. Models must account for time-varying correlations. Question 18. Mr. Steiner is validating a trading model reliant on Monte Carlo simulation. He discovers inconsistent pricing for exotic derivatives. What should he do? A. Ignore anomalies. B. Review model assumptions, improve paths, adjust volatility surfaces, and document validation results. C. Only test with Black-Scholes. D. Wait for peer review. Correct answer. B. Review model assumptions, improve path, adjust volatility surfaces, and document validation results. Explanation. Exotic products require precise calibration. Validation involves ensuring consistency in inputs and assumptions, with proper documentation per model governance standards. Question 19. What is the significance of model transparency in regulatory expectations? A. Improves marketing appeal. B. Ensures models are interpretable, audit-ready, and reproducible by second-line reviewers or supervisors. C. Only helps developers. D. Regulators don't care about internal model logic. Correct answer. B. Ensures models are interpretable, audit-ready, and reproducible by second-line reviewers or supervisors. Explanation. Transparency is a pillar in SR 11.7, ECB TRIM, and model audit frameworks. It supports governance, reduces misuse, and aligns with regulatory demands. Question 20. Why is model inventory management critical in large financial institutions? A. It helps sales planning. B. It prevents model duplication, tracks status, flags retirement needs, and supports audit trail requirements. C. It's optional under Basel. D. It replaces stress testing. Correct answer. B. It prevents model duplication, tracks status, flags retirement needs, and supports audit trail requirements. Explanation. Centralized model inventories ensure proper oversight, status tracking, and compliance with governance policies. Question 21. Dr. Lee notices multiple rejected trades on her FX algorithm post-release. Further analysis shows pricing skew due to data lag. What risk is this, and what should be done? A. Model risk from poor inputs. Suspend algorithm, update feeds, backtest outcomes, and revalidate. B. Credit risk. C. Liquidity mismatch. D. No action needed. Correct answer. A. Model risk from poor inputs. Suspend algorithm, update feeds, backtest outcomes, and revalidate. Explanation. Input data quality directly affects model output. Governance requires halting model use, fixing data issues, validating outputs, and reauthorizing deployment. Question 22. Which regulatory expectation mandates a comprehensive model risk management framework? A. IFRS 9. B. SR 11.7 and ECB TRIM require full lifecycle model oversight, including governance, validation, inventory, and documentation. Z. SOX. D. LCR. Correct answer. B. SR 11.7 and ECB TRIM require full lifecycle model oversight, including governance, validation, inventory, and documentation. Explanation. These guidelines enforce model lifecycle controls to mitigate systemic and idiosyncratic model risk. Question 23. Which risk increases when relying heavily on unvalidated machine learning models for credit scoring? A. FX risk. B. Model risk, including bias, overfitting, lack of interpretability. C. Inflation risk. D. Cyber risk. Correct answer. B. Model risk, including bias, overfitting, lack of interpretability. Explanation. Black box models may perform well in sample but fail out of sample. Regulatory pressure demands interpretability and fairness in credit decisions. Question 24. Ms. Bennett is auditing a model that lacks challenger comparisons. What should she do? A. Ignore if results seem accurate. B. Require challenger models to benchmark performance, document assumptions, and test stability. C. Only check equations. D. Wait for model owner approval. Correct answer. B. Require challenger models to benchmark performance, document assumptions, and test stability. Explanation. Challenger models are part of healthy model validation. They provide a benchmark to challenge assumptions and improve robustness. Question 25. A high R-squared value in a credit scoring model most likely indicates A. Good predictiveness under all scenarios. B. Possible overfitting. Further validation on out-of-sample data required. C. Strong causality. D. Model simplicity. Correct answer. B. Possible overfitting. Further validation on out-of-sample data required. Explanation. High in sample R2 may indicate overfitting. True performance must be assessed on unseen data. Question 26. Stress testing complements VAR by A. Being faster. B. Capturing tail risk and nonlinear exposures not evident in VAR. C. Removing the need for limits. D. Avoiding any data usage. Correct answer. B. Capturing tail risk and nonlinear exposures not evident in VAR. Explanation. VAR fails in extreme conditions. Stress testing bridges that gap by applying scenario-specific analysis. Question 27. Mr. Singh notices his credit model underperforms in high-interest environments. What should he do? A. Ignore unless defaults rise. B. Adjust for macro sensitivity. Test with forward-looking economic indicators. Recalibrate and revalidate. C. Stop using economic inputs. D. Increase PD uniformly. Correct answer. B. Adjust for macro sensitivity. Test with forward-looking economic indicators. Recalibrate and revalidate. Explanation. Macroeconomic shifts affect model performance. Updates and recalibration are part of lifecycle governance. Question 28. The key purpose of model benchmarking is A. Confirming legal compliance. B. Comparing performance against alternatives to justify continued use. C. Sales enhancement. D. Avoiding audits. Correct answer. B. Comparing performance against alternatives to justify continued use. Explanation. Benchmarking helps evaluate ongoing model relevance and performance against peers. Question 29. A poor model governance structure may result in A. Better sales. B. Regulatory penalties, financial loss, and systemic risk exposure. C. Improved agility. D. Reduced validation time. Correct answer. B. Regulatory penalties, financial loss, and systemic risk exposure. Explanation. Weak governance exposes institutions to errors, fraud, and regulatory breaches. Question 30. Dr. Ray implements a new pricing model for equity derivatives. 6 months later, P&L shows unexplained variances. What's the next step? A. Ignore unless flagged by audit. B. Conduct root cause analysis. Assess input data, rerun validations, and review implementation process. C. Remove historical data. D. Blame traders. Correct answer. B. Conduct root cause analysis, assess input data, rerun validations, and review implementation process. Explanation. Model performance review is critical post-implementation. Unexpected outcomes must trigger governance review.